Hey guys, welcome back to another episode. Today we're going to take a closer look at Super Microcomputer. The company reported earnings earlier this week. Unfortunately, we can see from the stock in the past 5 days is down roughly 13.7%. Obviously, Super Micro is doing amazing year to date. The stock is up over 174%, but we can see from its yearly high, the stock is down nearly 34%. So we do have a lot of great information that came out from the earnings. They talk about liquid cooling, they talk about their gross margins, about future growth potentials. And at the end of the episode, I also want to share kind of my overall thoughts on the company, where I see the current valuation. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so like always, I have this amazing slideshow that I prepared for you guys. So the first thing we're going to take a closer look at is Supermicro did mention that they are on track to have roughly 5,000 racks capacity per month, and that's expected by the end of fiscal year of 2024, which is the end of this upcoming quarter. So within three months, they believe they can do about 5,000 racks per month. And they do mention out of these 5,000, 2,000 plus will be direct liquid cooling. And this is something that's very important as we are kind of moving into the space where AI chips are getting stronger, are getting more power hungry. And in return, when they become more power hungry, they need to have better cooling solutions. Right now, we are kind of seeing more of an air cooled platform, but we are seeing that if things continue to go the way they're going, we might transition more into a normality of liquid cooling. And liquid cooling can help out a lot. These data centers, it can help things like reduce the overall real estate that they need, because with liquid cooling you can pack a lot more stuff together. You need a lot less air cooling space. You also use a lot less electricity, right, because you're not using a lot of kind of all these real estates and all these kind of air cooling solutions as well. So in forms of efficiency, Supermicro is really pushing into this liquid cooling. So there was a question during the Q&A session of the earnings call, and one of the analysts was like, hey, two questions. First, do they design most of their liquid cooling in-house, and two, are they able to charge kind of a premium when it comes to liquid cooling? And the CEO does mention is that, hey, look, they do design some key components for direct liquid cooling, DLC, in-house, but they also kind of do a mixture of both. They obviously use third-party components when they need to, right? Probably things like hosing and other solutions that you don't really need to re-engineer are part of are part of third party, and can help kind of improve margins there instead of creating a whole new solutions. But they say that customers pay a very minimal premium when upgrading, because, and not only that, so that it's only a kind of a very minimal premium when you upgrade to liquid cooling, but on the other end, they save up to 40% on energy costs versus air cooling. So here we can see that Supermicro, they're not trying to increase the pricing too much. Obviously, maybe there's competition in this, so there's not extreme pricing power here, but they also want to make it where it's easier for these other customers to transfer into liquid cooling, where maybe Supermicro can make a little bit more margins because some of the components that they make come from in-house. Now, they do mention that, hey, look, they are on track to produce over 2,000 liquid cooling racks per month of AI servers, with volume steadily increasing. And like I mentioned, right now, these racks are going super crazy in forms of power. We have racks of over 100 kilowatts, 120 kilowatts, and most of them are obviously kind of those Nvidia GPUs with the H100, the H200, and the B200. And Supermicro thus mentions that because of those new platforms from Nvidia, they do expect to continue to grow here in the direct liquid cooling market, and just in the overall AI server market. So they had to give a special thanks to Nvidia. So right now, we definitely do see that, hey, look, direct liquid cooling is something that's gonna be very important going forward as we continue to evolve into these chips, and these chips become more power hungry and need better solutions in forms of cooling. Obviously, Supermicro is not the only one that's doing this in this space. Nvidia has kind of created more of templates to showcase the other companies how to do it as well. But we can see that this is something that Supermicro has been doing for numerous years, so they might be a little bit ahead of the competitions. Before we go any further, we are now on the road to 50,000 subscribers by the end of the year. Thank you all for the crazy support. So if you haven't and are enjoying the content, make sure to hit the thumbs up and the subscribe button. Finally, if you want to support the channel a little bit more, make sure to check out my special offer at fool.com/Jose. Now back to today's episode. Now, the next thing I want to talk about is non-GAAP gross margins, and I think this is very crucial for investors to kind of keep a closer eye out. So we can see in the past few quarters, GAAP gross margins continue to decrease. You might be wondering, Jose, how is that happening if AI servers are expected to be expensive? Shouldn't gross margins be high, especially if this company's most of the revenue comes from AI servers? The question is, unfortunately, right now there is a very competitive space here in the AI server manufacturing. So for Supermicro to continue to gain market share, sometimes they have to focus on maybe better pricing moves or more aggressive pricing moves. And what that pretty much means is Supermicro could go to a customer and say, hey, look, you're getting your servers built by this company charging you X, Y, and Z. We can do that at a 5-10% discount. So this is what's overall kind of keeping Supermicro for the margins kind of continue to decline as they want to grow market share. Now we can see here from the CEO, the CEO does mentions that there is more and more competitive pressure here in the overall AI space. And as AI continues to get popular, that's going to continue. So to grow the market, they may sometimes, some deals may have to be a little bit more aggressive in pricing, but he does mention that they try to keep a balance. Obviously, probably the more and more you buy from Supermicro, the more aggressive they can be in pricing. Now, the next thing I want to take a closer look at is revenue. And maybe this is one of the things I want to say that investors kind of didn't like and saw the decrease in the stock price. We can see quarter three versus quarter two was not much of a gain. It was 5% quarter over quarter, and many investors were probably expecting a beat to their guidance. We can see their guidance was around 3.7 to 4.1 billion dollars. Supermicro came in with 3.85 billion. So I think investors were expecting a lot more, but we can see for quarter four of fiscal year of 2024, this company is going to grow a nice amount to roughly 5.1 to 5.5 billion dollars. So we can see quarter four, we are going to continue to see that nice growth here in overall revenue for Supermicro. Some other great things here, we can see United States is still a big portion of this company's total revenue with 70%. Asia comes in at 20%, Europe at 7%, and other at 3%. They also tell us that China, while you might think Asia 20%, that's probably all of China's revenue, they mentioned that China is only 1% of total revenue, but that makes sense, right? If AI servers can't really be shipped out to China, you're not going to see much growth there. Now, in forms of growth opportunity, there is a lot of things that can help grow Supermicro in forms of revenue. First, they mentioned for September and December quarter, they expect strong growth and believe the strong growth will continue for many quarters to come, if not many years. So obviously very bullish for the AI server and for AI chips. And the other thing that overall CEO mentions is not only are they gaining more new customers, but their old customers continue to grow as well. So they're growing market shares in expanding their own customers, but also new customers in general, which should obviously be a nice bullish sign for Supermicro. Now, we did see that the company did build up a nice amount of inventory in this past quarter. And the main reason is they want to have a huge quarter in quarter four. And we see from their overall guidance that it is going to be a record quarter for them, right? It's going to be almost more, it was going to be more than quarter three of fiscal year, quarter four of fiscal year 2023, and quarter one of fiscal year 2024 put together. So that in my opinion is insane of how quickly this company is growing. And they had to build up a lot of capital to be able to increase that inventory to make it for those quarter four shipments. So right now, one thing that maybe investors might be worried about or need to keep an eye out is this company, unfortunately, is a company that needs to build up capital to increase their overall inventory. And they even mentioned, right, the CFO actually mentions that they hope that they need more capital and they do more forms of capital growth because that means they have crazy amount of orders and they can grow revenue at crazy levels. Unfortunately, that Those capitals usually come in growth in capital, sometimes come in forms of debt or maybe in forms of share dilution, sometimes at a great kind of interest and kind of pricing. But obviously, if the market slows down and if they raise too much capital, that overall can hurt in the long term. But if you believe the AI market is here to stay, if they continue to raise capital, that can obviously be bullish for them in the long term of things. Obviously, in quarter three, it was mainly gained by AI servers, which is what we talk about. 50% of total revenue comes from AI GPU customers. And we earlier saw kind of that breakdown in geographic region. And one thing that I really want to showcase is all those regions actually grew on a year over year basis and on a quarter over quarter basis. So there is no slowdown happening in any part of the world. The United States is up roughly 240% on a year over year basis and up 3% on a sequential basis. Asia up 70% on a sequential basis. And the rest of the world is the only one that saw a decrease in 11%. My only thing there is maybe Supermicro is considering some of their United States customers a little bit more and maybe not focusing too much on maybe some of the smaller players in the rest of the world market. Other growth opportunities here for Supermicro is the upcoming next generation of Nvidia, the H200, the B100, the B200, the Grace Hopper 200, the Grace Blackwell 200 as well. Intel has their Gaudi 2, their Gaudi 3 incoming, and obviously AMD with the MI300 and MI300A. Outside of that, Intel is releasing a new server CPU, the Intel Xeon 6 processors, and AMD is also releasing new CPUs this year for servers with their Turin-based platform. So there's a lot and a lot of opportunities here for Supermicro to grow. So there's obviously a lot and a lot of bullish cases for this company. So why did the stock price go down? I want to say obviously the stock has kind of seen a nice jump from its overall year to date. It's up still 174%. In the past year, the stock is up over 486%. Now, if we take a closer look at valuation, and this is where I kind of share my overall thoughts if I would buy Supermicro at these levels. So a Supermicro PE ratio forward, which is the end of this fiscal year, and this fiscal year ends in this quarter. So about 3 months, PE ratio drops to 33. Personally, not that bad in my opinion. Now, Supermicro's PE ratio for 1 year, which is the end of next fiscal year, so about 1 year and 1 quarter, say 15 months from now, is about 23. That's also pretty not expensive. But the question is, obviously, if they can continue to grow, I believe maybe in the next 2 years, that PE ratio will actually drop into the high teens. I do believe there's a lot of growth opportunities for Supermicro. I'm not a fan of a business that has too much pressure from competitive pricing, where they have to be aggressive in pricing, where there's obviously a lot of competitors here. So for me, Supermicro might be a buy if it ever drops below that like 700, if it's closer to the low 600s. I'm not saying the stock is going to go there, but that is when I would really keep an eye out in buying opportunities. Right now, the overall semiconductor market has definitely seen quite a dive. Some of the other companies are trading at PE ratios a lot lower than they were a few weeks ago. Personally, I would rather look at those companies, but I'm not now that valuations have cooled down for Supermicro. I don't want to say this is the overinflated beast that it once was. I'm also not saying it's an undervalued beast either. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.